Millions of homeowners are on the brink, and almost nobody is talking about it. Mortgage delinquencies are quietly climbing to levels we haven't seen since the last crash. Home insurance costs are doubling, property taxes are spiking, and in certain cities, home values have already dropped more than 20%. If you bought your home recently, you may be sitting on a ticking financial time bomb. And it's not just struggling areas. Even so-called safe markets are seeing panic sales, price cuts, and desperate sellers. The truth? The housing crisis has already begun. It's just happening quietly, hidden in bank reports, foreclosure filings, and whispered conversations between real estate insiders. Today, we're exposing the data, the danger zones, and the traps that could destroy your equity and your savings. And most importantly, how you can protect yourself before it's too late. This is the Real Estate Scout, and this is the 2025 housing crisis nobody talks about. In this investigation, we're going to break down exactly what's happening in the housing market right now and why homeowners across the country are panicking. We'll uncover the hidden data the mainstream isn't showing you, from skyrocketing mortgage delinquencies to insurance premiums that are forcing people out of their homes. We'll look at the states and cities most at risk, and some of them will surprise you. You'll see how rising interest rates, property taxes, corporate pullbacks are creating a perfect storm that could hit your neighborhood next. We'll hear real stories from families already caught in the middle of this crisis. And we'll examine the financial traps silently draining equity from millions of homeowners. And we want to just cover the problems. We'll give you practical steps to protect yourself, your investment, and your future, no matter where you live. This is not a market update. This is a reality check. And if you own a home, plan to buy one, or even rent, you need to hear every word. Welcome to the Real Estate Scout. Let's get started. Everyone felt it, the sigh of relief. Headlines brightened, open houses filled, and friends started saying, "See, the worst is over." That feeling that calm's exactly what happens right before a storm breaks. Let's be honest about why the calm felt so convincing. Rates stopped spiking. Listings looked a little healthier. Builders offered perks again. Social feeds swung from doom to soft landing. But markets don't turn with a headline. They turn with pressures lowly, invisibly, and then all at once. Here's what that calm actually was. A pause in the visible pain, while the invisible pain compounded. Payment stress built behind closed doors. Insurance bills arrived. HOAs voted through fee hikes. Adjustable loans edged closer to reset dates. Families told themselves, "We're fine." We'll revisit this next quarter. That's the calm, not safety stalling. Picture a typical household. 2 incomes. Starter home bought when the news cycle sounded optimistic. It stretched because everyone else is doing it. The payments were a squeeze, but manageable barely. Then insurance renewed. Taxes recalculated. Childcare ticked up. Groceries didn't go back down. Nothing dramatic. Just every line item moving a little higher. That's how storms start. Not with thunder, but with drip, drip, drip. Meanwhile, the public story stayed cheerful. Low inventory will support prices. Buy now, refinance later. The worst is past. But inside the industry, the questions got sharper. Why are days on market creeping up in solid neighborhoods? Why are price cuts being disguised as price refreshes? Why are builder incentives so generous if demand is supposedly strong? Why do pre-approval letters feel shorter and stricter than they were just months ago? If you've been around markets long enough, you recognize the pattern. First comes denial. It's seasonal. Then rationalization, rates will drop soon, we'll be fine. Then delay, we'll list in spring. Finally, the oh no moment, the payment that really hurts, the job that looks less secure, the buyer that walks away at the last second. The calm feels safe because it's quiet. Quiet and safe are not the same thing. Let's decode the signals that appeared during the calm. Signal 1. Silent stress in household budgets. The mortgage isn't the only payment. Insurance, property tax, utilities, maintenance, HOA, car note, student loans costs that don't trend down because of a headline. When these stack, people cut spending elsewhere first. Then they tap savings. Then they swipe credit. The mortgage gets protected till it doesn't. Signal 2. The almost borrower. Lenders got more cautious. Margins tightened. A buyer who would have easily qualified a year earlier now gets a smaller number or more conditions or an outright no. That isn't visible on a chart, and it kills deals quietly. Signal 3. Shadow supply. Homes that aren't listed yet. Properties in pre-foreclosure limbo. Sellers who would sell at last year's price but refuse to adjust. Investors waiting to exit but not willing to blink first. Inventory that exists in the mind long before it hits the MLS. Signal 4. Builder behavior. When demand is truly strong, builders don't use heavy incentives. When they're worried, they protect sticker prices for optics and bury the discount in closing credits. Rate buy-downs, upgrades. That's not confidence, that's camouflage. Signal 5. The open house mirage. The foot traffic looks okay, but the offers are thin, and the serious buyers are picky. Agents say great interest, but interest doesn't close. And money is more selective in a real slowdown. Signal 6. The insurance reality. In risk-prone states and coastal corridors, renewals arrive like a plot twist. Premiums jump, coverage tightens, deductibles climb. Some carriers simply exit markets. The calm ignores this. The storm prices it in. Signal 7. Employer fragility. You don't need a recession to feel job risk. You just need one department consolidation. One hiring freeze, one missed bonus. Households budgeted for the best-case scenario. The calm assumed the best case would hold. Signal 8. Investor sentiment turning. FOMO became wait and see. Short-term rental math stopped penciling without ideal occupancy. Some landlords decided to list quietly, test the waters, or pivot to long-term leases at lower net yields. It's an early crack. Signal 9. Price psychology. Sellers anchor to yesterday's comps, buyers anchor to tomorrow's rates. Both sides wait, and volume dies first. Price follows volume, not the other way around. When you feel a market stuck, price discovery is next. Signal 10. The story versus the spreadsheet. The story says, strong demand. The spreadsheet says, after tax, insurance, HOA, and an average maintenance buffer, this payment is negative cash flow or razor thin. The spreadsheet wins eventually. Now let's humanize it. Meet a household like countless others. Call them Maya and Chris. They stretch to buy a 3-bed near good schools. Fixed rate, decent jobs, and a small emergency fund. The COM told them, you made it. Then the tax reassessment hit. Insurance jumped. The car needed work, so the bonus didn't come through. They weren't drowning, just treading water. So they paused vacations, trimmed subscriptions, and told themselves it was temporary. That's what most families do. They absorb, until one more bill tips the balance. On the other side of the transaction, a seller named Roland listed his rental. He wanted last year's price. He got showings, then silence. He cut once, then again, and he pulled the listing, telling himself the spring market would be better. The COM hands out comforting stories like that. But Roland's carrying costs don't care about stories. This is how the COM sets the stage. Households stretched, sellers stubborn, buyers selective, lenders strict, insurers cautious. None of these break a market alone. Together, they create the pressure that breaks quickly later. If you want to identify this phase in your city without relying on anyone's narrative, use this field checklist. One-track price cuts is a share of active listings in your zip code, not just the median price. To watch days on market for well-located turnkey homes. If those lag, demand is weaker than the headlines. 3. Ask agents about concessions, buy-downs, closing credits, repair allowances. Rising concessions are softness in disguise. 4. Monitor fall-through rates deals going under contract and then failing. Growing fall-throughs signal thin financing and cold feet. 5. Check your county site for pre-foreclosure filings. You'll see stress before it hits public inventory. 6. Call an insurance broker and price a sample policy. If costs or deductibles jump, that changes affordability today. 7. Talk to lenders about pre-approval strength. If letters are tighter or expire quicker, liquidity is thinning. 8. Drive new build communities. If models are busy but spec homes sit, incentives are doing the heavy lifting. 9-track rental vacancy and effective rents. Weakening rents compress investor demand and spill into prices. 10. Recalculate total monthly ownership cost at today's premiums and taxes. Don't rely on last year's numbers. In the calm phase, most people compare against the past. It's better than last winter. It's not 2008. That's the wrong comparison. You don't compare to yesterday, you project tomorrow. You ask, with costs where they are and credit this tight, who is the next marginal buyer and at what price? There's another trap. Optimism with a clock on it. Rates will drop soon. Maybe. But buyers don't purchase with a wish. They purchase with approval and confidence. If rates inch down but insurance and taxes keep climbing, the payment doesn't heal enough. And if rates do fall sharply, inventory often appears sellers who are waiting suddenly list, blunting the price bump. The calm turns those nuances into one simple, misleading idea. Just wait and it'll fix itself. For homeowners, the action in the calm is not to panic sell. It's to run numbers ruthlessly. If your total cost is rising, trim early, not late. If your loan resets soon, start options now, re-extension, restructure, or downsizing. If you're sitting on equity, decide whether it's working for you or holding you hostage. If you're fine on cash flow, but stressed by risk, price out insurance alternatives, mitigation, or relocation before the rush. For buyers, the action in the calm is patience with precision. Don't chase listings that look pretty but fail on math. Target motivated sellers, not wishful ones. Focus on quality, location, build integrity, schools, commute. Weak markets punish compromises. Strong fundamentals hold value when the weather turns. For investors, the calm is when you build your playbook, not your portfolio. Line up financing, verify rent comps after concessions, and model higher non-mortgage costs. If you can't make it work with conservative assumptions, don't tell yourself a story. The spreadsheet is the story. This is the Real Estate Scouts. Our promise is not to soothe you, it's to show you. The calm before the storm isn't peace. It's preparation time. The households and investors who win aren't the loudest during the calm. They're the ones quietly fixing balance sheets, renegotiating terms, and choosing discipline over dopamine. And when the first big gust hits, price cuts widen, listings stack. Distressed supply surfaces. The people who use the calm wisely won't be shocked. They'll be ready. Now that you can recognize the calm for what it is, we're going deeper into the mechanics. The data points almost no one is watching, and why they matter more than the comforting narratives. Let's pull the next thread. Chapter 2. The data nobody talks about when markets turn. The most dangerous numbers aren't the ones on the evening news. They read the ones buried 3 layers deep in reports that most people never read or never even know exist. These are the numbers that don't get headlines, but move billions in capital. And right now, they're flashing warning signs in almost every region of the US. First, mortgage delinquencies. On the surface, national delinquency rates look manageable. But if you strip out the states still buoyed by short-term migration or post-pandemic cash buyers, the picture changes. In the bottom 20% of markets, serious delinquencies, payments overdue by 90 days or more, are climbing at the fastest pace since 2009. Not spiking, not crashing, climbing, quarter after quarter. That's how it starts. And here's the part nobody talks about. Banks Dan-T report these in real time. By the time you see a wave of foreclosures, those loans went bad months ago. The data is always lagging, which means if you wait for confirmation, you're already late. Second, shadow inventory. This is the hidden supply of homes not yet on the market, but already in trouble. Properties in pre-foreclosure. Homes where owners are 60, 90, 120 days behind, but haven't listed yet. In some counties, for every foreclosure you see listed, there are 2 or 3 in the pipeline, waiting to hit the MLS at the worst possible time, when demand is already shrinking. Third, the investor exit rate. Big investors, the hedge funds, and corporate landlords who bought thousands of homes during the boom are quietly offloading. They're not dumping everything in fire sales. The ones with older roofs, bad tenants, or high insurance costs, Why does that matter? Because when institutional money starts to leave a market, it's a leading indicator. These groups have the research teams and risk models to spot trouble months before it is visible in retail sales data. Fourth, insurance premium inflation. In Florida, Louisiana, Texas, and parts of California, homeowners are seeing annual premiums jump by 30%, 50%, even 100%. This isn't just a coastal problem. Inland states hit by severe weather are getting reevaluated by insurers. Even if your mortgage is fixed, this cost isn't, and lenders require coverage. If you can't afford it, you're forced to sell, or worse. Fifth, tax reassessments. Counties reassess home values periodically, and in a boom, that means higher property taxes. But here's the trap. These assessments often lag up into a downturn. You could see your tax bill jump even as your home value falls. For households on the edge, that's the breaking point. Sixth, the credit tightening index. Banks are quietly making it harder to borrow, loan-to-value ratios are dropping, debt-to-income limits are stricter. Some products, like low-down payment investor loans, are disappearing. Most buyers never notice because they only talk to one lender. But when you step back and see the pattern across dozens of banks, the shift is clear. Money is getting harder to get. Seventh, rent-to-price divergence. In a healthy market, rent prices and home values move together. But in some metros, home prices are still inflated, while rents are flat or falling. That's bad for investors because the yield is collapsing. And when enough investors leave, it removes a chunk of demand from the buying pool, putting more downward pressure on prices. Eighth, price cut velocity. The number of listings with price reductions is rising in many cities. But more important than the count is the size and speed of those cuts. In normal markets, a seller might drop $5,000 after 30 days. In weak markets, they're cutting $20,000, $40,000, sometimes within 2 weeks of listing. It's panic behavior. Ninth, days on market for perfect homes. If those start sitting, it means demand is weakening at the top end of the quality spectrum, which is usually the last to fall. 10th, the foreclosure to sale gap. This is the time between when a bank takes back a property and when it actually sells. In hot markets, it's weeks. In stressed markets, it can stretch 2 months. That gap is widening in multiple states right now. When you connect all these data points, a pattern emerges. Payment stress is building quietly. Hidden inventory is waiting to hit. Big money is quietly exiting. Ownership costs are rising faster than incomes. Credit is tightening even before a visible crash. The public won't see the storm until the numbers hit the headlines, and by then, it's too late to react. This is why the real estate scout tracks the quiet indicators. They're early, they're subtle, and they're the difference between getting caught in the flood or stepping aside before the water hits. But the very real reasons homeowners are panicking right now. Chapter 3. Why homeowners are panicking. If you've been talking to homeowners lately, you might notice a pattern. Even the ones who seemed calm a year ago are now anxious. They're not just worried about home values. They're terrified about whether they can even stay in their homes. The panic starts with affordability. The average 30-year fixed mortgage rate right now is hovering near 7%. Combine that with the fact that home prices in most major metros are still near record highs, and you get the most unaffordable housing market in decades. According to Redfin, the typical U.S. homebuyer now needs an income of $114,000. Just to afford a median-priced home, that's nearly double what it was just 4 years ago. Then, there's the refinancing trap. Millions of homeowners locked in ultra-low rates during 2020 and 2021. But now, rising insurance costs, exploding property taxes, and unexpected repair bills are forcing them to borrow again. Except there's a catch. Refinancing at today's rates can easily add hundreds, even thousands to a monthly payment. Many are stuck in what economists call house-poor purgatory. Unable to move, unable to refinance, but also unable to keep up. Another reason for panic? Adjustable rate mortgages arms. Back in 2021 and 2022, many buyers took these loans to get lower initial rates. Those teaser rates are now expiring, and monthly payments are jumping by $500. $1,000, sometimes more. According to data from CoreLogic, ARM resets are expected to hit over $200 billion in outstanding loans in the next 12 months. That's a wave of payment shocks that could push thousands into default. But here's what most people don't realize. Even homeowners with no mortgage aren't safe. Why? Because of the property tax and insurance crisis. If your home is paid off, but your taxes and insurance alone are $10,000 or $15,000 a year, you can still lose it if you can't pay. And that's exactly what's happening in places like Florida, California, parts of Texas. We're already seeing retirees, people who thought they were financially secure, being forced to sell because they simply can't afford to own their homes anymore. Add to this the growing fear of declining home values. In certain overheated pandemic boomtowns, Boise, Austin, prices are already down 10% to 15% from their peaks. For homeowners who bought in the last 2 to 3 years with minimal down payments, that's enough to wipe out all their equity. Once people feel trapped in a house that's worth less than they owe, panic spreads fast. And let's not forget the emotional toll. Owning a home isn't just a financial decision. It's tied to your sense of stability, your family's security, and your future. When people start to feel that slipping away, they don't just worry, they panic. And panic leads to quick sales, distressed listings, and the very kind of market slide that makes the panic worse. This isn't just a statistic. This is a chain reaction. And it's already started. Next, we're going to break down the warning signs you can look for in your own neighborhood, so you know if your market is about to turn ugly. And trust me, some of these are easier to spot than you think. This is the Real Estate Scout. Chapter 4. The domino effect we're about to see in real estate. A crisis doesn't hit all at once. It starts with a few cracks, and then those cracks spread. What's coming in 2025 isn't just about high rates or falling prices. It's about a chain reaction that could take years to fully play out. Here's how the domino effect works. Domino number 1, affordability collapse. We've already seen the first tiles tip over. Mortgage rates stay high, prices remain inflated, and buyers drop out of the market. Less demand means homes sit longer. Sellers who need to move start cutting prices just to attract offers. Domino number 2, price softening turns into price freefall. When a few sellers lower their prices, the comps in the neighborhood reset. Suddenly, appraisers are valuing similar homes lower. Buyers use that as leverage to negotiate even steeper discounts. This isn't a slow leak. It's like a vacuum pulling prices downward. Domino number 3, equity wipeout. For recent buyers, especially those who bought with 3% or 5% down, even a 10% drop in value can erase all equity. Once you're underwater, owing more than the home is worth, your options vanish. That's when desperation starts. Domino number 4, distressed sales surge. Underwater owners who can't make payments start missing deadlines. Some try to sell quickly to avoid foreclosure. Others walk away entirely. 2008, we saw entire neighborhoods with for sale and bank-owned signs on every block. The early indicators are already here. Domino number 5, investor retreat. Big institutional investors, the wall, street-backed companies who bought thousands of homes during the pandemic, are already quietly reducing their portfolios. They're not emotional. They see the numbers turning. When they sell, they don't care about neighborhood values. They care about cashing out fast. Domino number 6, rental market shock. As investors exit, rental supply floods the market. Rents drop, which sounds good for tenants, but it also destroys the cash flow math for landlords. Many mom-and-pop investors are forced to sell, adding even more inventory to a declining market. Domino number 7, credit tightening. Banks start to panic. They raise lending standards, require bigger down payments, and scrutinize every loan. That chokes off the pool of buyers even further, a perfect recipe for deeper price drops. Domino number 8, psychological collapse. Here's the part most people don't factor in. Real estate isn't just numbers. It's emotion. When headlines scream home prices falling, people delay buying. Even those who can afford a home wait for better deals. That hesitation freezes the market, and the cycle keeps spinning downward. And here's the kicker. This entire domino sequence can unfold without a major national recession. It's localized, it's market by market, and it's already underway in places like Austin, Phoenix, Boise, and parts of Florida. The scary truth? Once the first few dominoes fall, there's no easy way to stop the chain reaction. That's why it's so critical to know exactly where your market stands right now. Because when the panic hits, you won't have time to react. This is the Real Estate Scout, Chapter 5. The silent killers of the market when a housing crash is in the headlines. Everyone talks about the obvious stuff. High interest rates, falling sales, fewer buyers. But what really destroys a market are the things you don't see coming. I call them the silent killers because they work quietly in the background until the damage is irreversible. Silent killer number 1. The inventory surge that sneaks up on you at first. Listings creep up slowly. A few more homes on the market each week, no big deal, right? But behind the scenes, expired listings and withdrawn homes pile up. This shadow inventory, properties that will eventually re-enter the market, creates a hidden wave of supply just waiting to hit. By the time it's visible to the public, prices are already under pressure. Silent killer number 2. Insurance premium shock in places like Florida, California, and parts of Texas. Home insurance rates have doubled or even tripled in just a few years. For some homeowners, that extra cost is the breaking point. For buyers, it can completely destroy affordability. And here's the thing. Insurance costs aren't usually part of the headline mortgage rate conversation, but they can kill deals faster than rising interest rates. Silent killer number 3, HOA, and special assessment tsunamis if you own a condo or live in a planned community. Your HOA might be sitting on massive maintenance issues. Aging roofs, plumbing, foundations. When the bill comes due, they don't ask politely. They send a special assessment. That surprise $15,000 or $30,000 payment pushes people into selling quickly, adding more distressed inventory to the market. Silent killer number 4. Local job losses that don't make national news. Not every market needs a national recession to crash. Sometimes it's one major employer shutting down, a factory moving overseas, or a tech hub laying off workers. These local shocks quietly drain buying power from an area. Home prices start to slip, and then the neighboring towns feel it too. Silent killer number 5. The investor exit floodgate. Big landlords and corporate buyers don't warn you before they sell. They just sell, and they sell in bulk. The public only finds out months later when prices have already dropped. They'll list dozens or hundreds of homes at a discount just to get cash out fast. That move resets the entire pricing floor for an area overnight. The danger with these silent killers, you're invisible until it's too late. By the time they show up in Zillow data or the evening news, the market is already shifting under your feet. And that's why, if you're a buyer, seller, or investor, you need to be watching these signs like a hawk. Because when they all line up, inventory spikes, insurance costs explode, HOAs drop a bomb, jobs vanish, and investors run. The crash is no longer coming. It's already here. Subscribe to the Real Estate Scout. Chapter 6. The states and cities most at risk. Not all markets are created equal. And in 2025, some states and cities are sitting on a financial powder keg. We're talking about Florida, slammed by soaring insurance rates, hurricane risk, and overbuilt markets like Cape Coral and Naples. California, with its sky-high home prices, tech layoffs, and wildfire danger threatening affordability from San Francisco to Sacramento. Texas, where once booming cities like Austin and Dallas are facing an oversupply problem, slowing migration, and rising property taxes. Then there's Arizona, Phoenix, and Tucson, in particular, hit hard by water shortages, overdevelopment, and investor pullouts. And Dan T overlooked the Midwest. Michigan and Ohio have pockets where local job losses could quietly gut housing demand. The bottom line, these aren't just numbers on a chart. These are real communities, real families, and real financial risks. If you're buying, selling, or investing in these areas, your timing could make or break you. Asterisk. In the next chapter, we all talk about the human side of the crisis. The moves you need to make now to protect your wealth and come out ahead. This is the Real Estate Scout. Behind every foreclosure notice, every for sale sign, and every price drop, there's a family, a story, a struggle. It's the retired couple in Florida watching insurance costs eat up their savings. The single mom in California forced to sell because her adjustable rate mortgage just doubled. The young family in Texas moving back in with parents after job cuts and rising bills. These aren't just statistics. They're people watching their dreams slip away while the market turns cold around them. And here's the truth. In a crisis like this, it's not always the biggest investors or the banks that take the hardest hit. It's the everyday homeowner, the ones who believed they were safe until reality hit their doorstep. If you take one thing from this video, let it be this: the earlier you act, the more control you keep over your future. This is the Real Estate Scout, and we're just getting started. Chapter 8. What homeowners can do right now. The market may be unpredictable, but your next moves don't have to be. Hear us what smart homeowners are doing right now to protect themselves, and what you can do too. 1. Lock in your mortgage rate. If you have an adjustable rate mortgage, talk to your lender about refinancing into a fixed rate before costs climb higher. 2. Slash unnecessary expenses. Every dollar you save now is a safety net later. Cancel unused subscriptions, shop smarter, and cut non-essentials. 3. Build a cash cushion. Aim for at least 3 to 6 months of living expenses in an emergency fund. That's the difference between weathering the storm and losing your home. 4. Get your home's real market value. Don't guess. Get a professional valuation. It could reveal opportunities to sell or refinance before prices dip further. 5. Consider renting a room or part of your home. Extra income can cover rising taxes, insurance, or mortgage payments without forcing a sale. 6. Stay informed, not scared. Knowledge is your greatest weapon. Follow credible real estate updates. And yes, that means subscribing to the Real Estate Scout so you don't miss what's coming next. This isn't about panic. It's about preparation. The ones who act early don't just survive the storm. They come out stronger on the other side. Chapter 9. How to turn this crisis into opportunity. Every crisis is also a reset button. While some are scrambling to hold on, others are positioning themselves to win big over the next decade. Here's how you can be one of them. 1. Watch for distressed properties. Foreclosures, short sales, and price drops can mean huge discounts if you're ready to move fast. 2. Partner with others. Pooling money with friends, family, or trusted investors can open doors to deals you couldn't reach alone. 3. Focus on cash flow, not just appreciation. Buy properties that pay for themselves through rent, so you earn even if prices stall. 4. Upgrade strategically. If you're staying put, use this time to improve your home's value with smart, high ROI renovations. 5. Learn before you leap. The best deals go to those who understand the market. Study trends, follow local data, and stay ahead of the news. The truth is, when the dust settles, people will look back and see that this was the moment fortunes were made and lost. Which side of that story you're on depends on the actions you take today. Stay prepared, stay informed, and remember, the Real Estate Scout will be here to guide you through every step. We've covered it all. From the calm before the storm to the data no one is talking about. From the panic gripping homeowners to the silent killers hiding in plain sight, we've seen how one small shift in rates can trigger a domino effect that rattles entire states, and why even so-called safe markets aren't immune. We've looked at the human side, the real families, the real fear, and we've talked about what you can do right now to protect yourself, and even turn this crisis into an opportunity. But here's the truth. The next 12 months will decide the future for millions of Americans. Some will lose everything they've worked for. Others will position themselves to build generational wealth. Which side you end up on will depend on the choices you make today. If you value truth over headlines, if you want the facts before the fallout, subscribe to the Real Estate Scout right now. We're uncovering what others won't, so you can be ready for what's coming next. Stay alert, stay prepared, and we'll see you in the next video.